Welcome to Manifested Publishers. We offer CASNEP study materials and video lectures.
Hello everyone, I'm glad to have you once again at the Manifested e-learning platform. In our today's lesson, we will introduce the double entry concept, the concept of double entry. In our previous lesson, I took you through the rules of recording transactions in ledger accounts, and the rules were in relation to assets, liabilities, capital, expenses, and revenues. We say that when there is an increase in an asset account, the asset account is debited, while a decrease in an asset account reduces the asset account, and so the asset account is credited. We also learned that where there is an increase in liability account, then the liability account is credited, while a decrease in liability account, the liability account is debited. The same treatment we accorded liabilities account, we accord the capital account. That means an increase in capital account is credited and a decrease in capital account is debited. We went ahead and put down the rule for the expenses. An increase in expense account is debited, whereas a decrease in expense account is credited. Then an increase in revenues account, in any of the revenues account, an increase is credited, whereas a decrease is debited. Now it is on the basis of these rules that in our today's lesson we are going to look at the concept of double entry. Concept of double entry. Concept of double entry. Concept of double entry. Learners, bookkeeping is based on the principle of double entry. Bookkeeping is based on the principle of double entry, and the most important concept in this principle is that for every debit entry there must be a corresponding credit entry. For every we said the most important concept in this principle is that for every debit entry there should be a corresponding credit entry. And remember, in our last lesson we said that debit entry is simply an entry that is made on the debit side. Credit entry is an entry that is made on the credit side. So this is the double entry concept. It says that for every debit entry made in an account, there has to be a corresponding credit entry made in a different account. And that would mean that for every transaction there is an account to be debited and an account to be credited for every transaction, be it purchasing of assets, paying the creditors, introducing capital in the business, or receiving income like rent, or making expenses like buying of stationery. For each and every transaction, there has to be two entries that are made, either on the debit side or the credit side. In this lesson, I will introduce the steps that should be followed in making entries in the ledger accounts. What are the steps that should be followed when making entries in the ledger accounts? Steps to be followed when making entries in the ledger account. Step number one is to identify. Step number one, identify the accounts. Identify the accounts affected by a transaction. If you have a transaction, before you record it, first you need to identify which two accounts or more than two accounts are affected. Identify the accounts affected by a transaction. Step number two, classify each account. Classify each account as either an asset, liability, capital, expense, or revenue. An account can either be an asset account, or liability account, or expense account, or capital account, or revenue account. Remember, step number one, identify the two accounts that are affected. So the two accounts affected by a transaction can either be an asset account, liability account, capital account, expense account, or revenue account. That is step number two. Step number three, learners. Step number three, determine whether each of the account has increased or decreased. Determine whether each of the account has increased or decreased. Remember, we said if an asset increases, it has to be that transaction. If a transaction increases an asset, then that transaction will be recorded on the debit side. If a transaction reduces a liability, then that transaction has to be recorded on the debit side. So it's important to determine whether each of the account has increased or decreased. Then, having done that, step number four, decide the side. Decide the side of the account. The side of the account on which to make the record, and it can either be debit or credit. That is, you will either debit or credit. You can either debit or credit. And learners, now you see why we learned the rules in our last lesson, so that you can tell when there is an increase in an asset, do you debit, do you credit? When there is a decrease in an asset, do you debit or do you credit? When there is an increase in a liability, do you debit or do you credit? When there is a decrease in a liability account, do you debit or do you credit? Where there is an increase in capital account, do you debit that capital account or do you credit it, and so on. That's what we learned in our last lesson. So the double entry system is a straightforward concept. Is a straightforward concept, a very important concept. And let us now try and apply these steps. We are going to have some examples. Example. Example number one of a transaction. I want to list some transactions here, and then we see how the transactions can be recorded in the ledger accounts using the concept of double entry. Number one, on 1st of January, Iraya started a business. With 560,000 shillings cash. That is a transaction. You want to record these transactions in the ledger account. So we said step number one is to identify which two accounts are affected by this transaction. Which two accounts are affected by this transaction? And that one, we just get it from the question. Started business. When you start business, the first account that should be identified is the capital account. So we'll have capital account. That is one account. Capital account. And we said an account has two sides. There is the debit side and the credit side. So we have a column for the date. Okay, the date. Let's say this is, let's give it a year, 1st January 2019. 1st January 2019. So we'll have the date 2019. This is January 1. Then you'll have a column for the details. On the other side, you'll also have the column for date. This is 2019, January 1. So that is just an account showing the year. We'll put the dates when recording. Then you'll have column for details and folio. I'll skip the folio for now. Then we have the amount, column for amount. So this is the format of an account. Generally, this is how an account looks like. So on 1st January, we have Irai has started a business, so we have to open a capital account. Then he started with 560,000 shillings cash. That means we'll open a cash account. We'll have cash account. Those are the two accounts that are affected by this transaction. We have the cash account, cash account. So there is the debit side and the credit side. So we've first identified the two accounts. Step number 1, identify, let me take you to the steps. Identify the accounts affected by a transaction. So we have capital account and cash account. Then step number 2, classify each account as either asset, liability, capital, expense, or revenue. This capital account is a capital account. Cash account, we all know by now, is an asset account. So we have identified or classified. This is a capital account. This is an asset account. That is step number 2. Step number 3, determine whether each of the account has increased or decreased. Determine whether each of the account has increased or decreased. Irai has started a business. That means the capital account has increased. Okay, capital account has increased. At the same time, has this cash account increased or decreased? Money is brought into the cash account. It means this cash account again has increased. Okay, cash has gone up. He has introduced capital. Capital has increased. So when capital account is increased, do we debit or should we credit? We learned that when capital is increased, then the capital account is credited. So we are going to write the date. This is January 1. Then we write the corresponding account under details. Remember, we said that this details is used to record the other account affected by the same transaction. We have identified the other account affected by this transaction rather than capital is cash. So we're going to write here cash. The amount is 560,000. 560,000. So that is credit entry. This is a credit entry. In other words, we have credited the capital account with cash amounting to 560,000 shillings. Under the double entry system, we said for every credit entry, there must be a corresponding debit entry and vice versa. So this is a credit entry. If only two accounts are affected and one account has been credited, then the other account has to be debited. So we are going to debit the cash account. We are going to debit the cash account. We have the date. Have the date. It's 2019. We have the details. Column for details. Then we'll have column for the amount. Column for the amount. So we will indicate the date, the same date, January 1. The details, under details we record the capital account. This is cash account has received 560 from capital. the capital account 560,000. So we have effected the transaction, double entry. We have one transaction, two entries, double entry. Every transaction has a dual effect on the accounts of a business. So that is how to record this transaction. On 1st January 2019, Iraya started a business with 560,000 shillings cash. Learners, we will take another example. Example number 2. Example number 2 on how to effect the double entry concept. Double entry concept. I'm taking example number 2. You can say on 5th January, Iraya bought furniture. Bought furniture worth 70,000 shillings on credit from Amani Furnitures Limited. Amani Furnitures Limited. This is a transaction. Step number 1. Step number 1. Step number 1, identify the accounts affected by the transaction. What is the transaction? On 5th January, Iraya bought furniture worth 70,000 shillings on credit from Amani Furnitures Limited. Candidates, we can see from the question there is an asset. He bought an asset. So this is an asset account. We call it furniture account. So we have furniture account is an asset account. Then we have another account known as Amani Furnitures Limited. He bought furniture on credit. On credit. When you buy goods on credit from a supplier, then that supplier is a creditor, and creditors is an account that falls under liabilities. So this is a liability account known as Amani Furnitures Limited account. Amani Furnitures Limited account. So these are the two accounts that are affected by this transaction. This is the debit side, the credit side, debit side. That is step number 1. Identify the accounts affected. Then step number 2, classify each account as either asset, liability, capital, expense, revenue. I've already done that. I've said this is an asset account, this is liability account. Step number 3, determine whether each of the account has increased or reduced. Bought furniture. That means this furniture account is increased. When you buy furniture, you increase furniture. So it has increased on this is 2019, January 5. The details, under details, we have the corresponding entry, which is Amani Furnitures The amount is 70,000. 70,000. So this account has increased. How about the liability account? Has it reduced or increased? This account has increased. Iraya's liability has gone up. Liabilities have gone up. He has another creditor that he has to pay. That means this account has increased. So we have the year 2019, on the same date, January 5. When a liability increases, remember we said you increase or you credit that account. So we credit this account. Under details or particulars, we are going to write the corresponding account, which is furniture. The amount is 70,000. 70,000. So these are accounts, learners. So remember the definition of an account. We said an account is a chronological record of the transactions of a business affecting particular accounts. Is a chronological record. Chronological recordings of transactions of a business. An account is a chronological record of transactions affecting a particular item. So any transaction that is related to furniture will be recorded in furniture's account. Any transaction related to furniture will be recorded in furniture's account. And remember we said bookkeeping helps us have a systematic and proper record of the transactions. In this second one, I'm giving an example. This is Amani Furnitures Limited. Any dealings with Amani Furnitures Limited will be recorded in Amani Furnitures account. Anytime the business makes any transaction that is related to Amani Furnitures Limited, then you'll have it in a chronological format. The date, the details will be shown, and the amount, so that anyone who wants to look at the records of this business, there is a proper record. So that is that is a second example. Let's try another one. We are going to do another example. Example number 3. Number 3. Iraya borrowed a bank loan of shillings 300,000 and deposited the money in a bank account. Deposited all the money in the bank account. This is another transaction. Raya borrowed money. You can even have the date, say on 3rd of March 2019. That is a transaction. Iraya went to the bank and was given a loan, 300,000 shillings, and he deposited all this money in his bank account. The question is, which two accounts are affected by this transaction? Iraya borrowed money from the bank. Okay? So we have loan. This is a loan. This is a loan account. Number one, we have bank loan account. Number two, deposited the money in a bank account. So we have bank account. Bank account. This money was taken, deposited in his account. So that is step number one, identify the two accounts affected by the transaction. Step number two is to classify these two accounts. Is this an asset, a liability, capital, expense, or revenue? Bank loan. Loan, when you borrow money from a bank or from any institution or from individual, then that individual becomes a liability. That loan becomes a liability. Liability means that Uriah has an obligation to pay because he borrowed. This is not his money. He's liable to pay. So that is a liability. This bank account, is it an asset account, liability account, expense account, or revenue account? Bank account is an asset. So that is step number two. Then step number three, what did we say? We said determine whether each of the account has increased or decreased. Uriah borrowed money. Has this account from a bank, has this account reduced or increased? This account has increased. Bank account has received money. Has this account increased or reduced? This account has increased. Borrowed money, that means the money that he has in the account will go up. Is that clear? That should be clear. So then we check if liability, this is a liability. If liability account has increased, do we debit or do we credit? The rule, remember, is we credit. So we have the debt. This is 2019 March 3. Under details, we write the corresponding account. This one here, we write bank. Then the amount. The amount is 300,000. We credit. This is 300,000. 300,000. 300,000. So double entry concept. For every credit entry, we have credited this account. For every credit entry, there must be a corresponding debit entry. If this account is credited, then the other one should be debited. So we debit, we indicate the date. The date is 2019 March 3. Under details, we have the details. The detail, we will write the name of the corresponding account, which is bank loan. The amount is 300,000. So that is example number 3. Example number 3. Learners, that is how to effect this transaction. And I will stop there so that I can give you an opportunity to practice. I'll give you assignment, and that assignment I'm going to write it on the board. The following transaction took place in the business of Mitalo. This is the exercise. learners, that is your assignment. That is your assignment. That is the exercise. It says the following transactions took place in the business of Wendy and Sons. On July 1st, started business with capital in cash of 1,150,000 shillings. On June 2nd, opened a bank account and deposited 300,000 shillings. On June 3rd, bought building in cash 600,000 shillings. On 4th, borrowed a loan in cash 700,000 shillings. On 6th, bought stationery by check 50,000 shillings. On 6th, repaid part of the loan by check 100,000 shillings. You are required to record the above transactions in the ledger accounts of Wendy and Sons. Wendy and Sons. Wendy and Sons. So thank you for attending. Do the assignment before you attend our next lesson. I'll see you as we continue learning more about the double entry system of bookkeeping. Bye-bye.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners.